Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are going to discuss the 18-year real estate cycle. So many of you will probably recall the 2008 GFC, the crash. So at the time, I was my father's business. He had an oil distribution business, and the years leading up into the GFC, he was making good money. And then through 2008, 9, 10, 11, there was a significant downturn. And at that stage, I realized that also a lot of people's super got heavily impacted. A good 40, 50% of people's super pretty much got lost. So then I started digging around and looking into cycles and exploring and researching why that was the case and why no one could actually see that crisis coming. So I came across Philip J. Anderson, who the book on the right wrote The Secret Life of Real Estate and Banking, and also Fred Harrison, who wrote Boom Bust, who both actually predicted in these books the GFC, and their predictions were based off over 200 years worth of history, studying cycles from the UK and the US and Australia, which are driven by the land market. So highly recommend getting a copy of these books. I'm not promoting these books by any means. They study the history, study a lot of the stock markets and the land markets, and they are quite good to have as a source of reference to work out where we are in the cycle and how you can, I guess, best play your investments to take advantage of the booms and the busts, but also get yourself in a position where you can protect yourself and protect your wealth and your investments as the cycle plays out. So in their research and their studies, there is an 18-year real estate cycle. So some of you may recall the last peak of the real estate cycle was in 2007, before we went through the GFC, which crashed into 2008 and 9. So there's an 18-year cycle. It consists of 14 years up from the low or from the recovery from the previous cycle, and 4 years down with a mid-cycle slowdown in the middle. So right now, we've just come through the mid-cycle slowdown, which is 2022. The market's now recovering out of the mid-cycle slowdown, and we are on the way. Haven't passed the previous peak yet, but we're on the way, and next is the land boom into the peak in 2026, and then we'll go through the next major land-driven downturn after 2026. So the low will be in 2028 to 2030, based off history. So we can go back through. So the previous peak was 2007. And a lot of you may recall the dot-com bust in 2000 to 2002. That was a mid-cycle slowdown. And then goes back before that to the 91 recession we had to have, which was a land-driven downturn, which was the peak before was 1989. So these are all approximately 18 years spaced from peak to peak. So the 14 years up, the mid-cycle slowdown is typically the stock markets take a good hit, 50, 60%. Super takes a good hit because they're liquid assets. They can be liquidated quite quickly. Real estate takes a 5 to 10% hit in the mid-cycle slowdown. However, the land-driven downturn is a significant downturn, and that is driven by the land market, which is brought on by interest rates rising, getting to a point where they get pushed too far from the Federal Reserve and the Reserve Bank of Australia. At that point, people start defaulting on loans and they can't afford their repayments, and then that's then driven the land market downturn, which is again, stock markets can take even a bigger hit of even 60 to 70%, and real estate has a hit of anywhere between 20 and 30%, and some commercial assets can take even a larger hit. So we are fair way off it yet from the peak, but it shows on the screen here. So even starting in 1975, run up to 1981. This is history, and then it was a slowdown into 1982. Had a significant boom up into 1989, which most of the baby boomers lived through, and the famous 1991 recession we had to have, which was a significant land recession where interest rates got to 17.5%. People were defaulting on loans, and we went through the major land-driven downturn. That then recovered, and then in 94 recovery up into the peak of 2000, which is a peak before the Sydney Olympic Games, massive infrastructure spend leading up into 2000, and then there was a slowdown. That was the dot-com bust, famous dot-com bust. Stock market collapsed. The real estate market had a 5 to 10% slowdown. Post 2002 was a boom up into 2007, and then the famous GFC into 2008 and 9. So then we recovered in 2011 and 12, and then the lead up to the peak in 2018, 2019, and then we've just gone through COVID from 2020 to 2022, and we are now positioned on that yellow marker on the screen. Haven't yet passed the peak of pre-COVID levels yet, but we're on the way. We've been about 4 months in to the recovery, and we're about to enter the final stages of the cycle, which would be the land boom, where a lot of investment speculation gets driven into the market. Banks now are earning higher profit margins because interest rates are rising, so they'll be able to lend more money into the market. This is all going to filter down into the benefit of land price, and then FOMO will kick in, and every man and his dog will be talking up property. So, and that will lead us into the peak of 2026, and then interest rates will continue to keep rising, even though there's some commentators out there saying that they potentially can drop. Based off history where we are now, we're in a broad-based expansion. Construction development is going to really kick into overdrive. Lending is going to kick into overdrive, and we'll be away at the races up to the peak. So this information is good to understand when investing, because it allows you to not overextend yourself at the peak, not be over leveraged, have your cash buffers in play to allow you to sail through the bad times, but then also have yourself positioned ready to take advantage of the downturns, because the best value is picked up in the downturns. So counter-cyclical investing, if you're a value investor, if you look to invest and buy property for less than what it's worth and hold it for the long term. The best value is found within the mid-cycle slowdown and the major land-driven downturn. So it's a good gauge and a good indicator to understand history, because these points in the market where they're at the downturns is where the best value is picked up. But then also the peak is also good to not get carried away with the herd, not get sucked in with all the media, the FOMO, and rush into the market right at the peak, overpay. This is where the peaks are when you have to be most cautious, because if you, for instance, buy an off the plan apartment for $1 million and 1.5 million bucks at the peak of the market, you will most likely not be able to hold on to it because interest rates will get so high. And then if you can hold on to it, you'll be having to hold on to it for a good 10 plus years before you build any substantial equity in those types of assets. So it's a good framework to operate within, and it also allows you to cut through the noise and understand where we actually sit in the market, because there's a lot of spruikers, a lot of commentary, a lot of mainstream media, even some well-to-do commentators still don't understand the 18-year cycle. So I highly recommend doing a bit of research and getting an understanding of the cycle. So 2008, it's also good to understand pinpoint events during the major downturns, because they can be used as reference points. So Lehman Brothers is the fourth largest investment banker in the United States before they went bankrupt in 2008. 2008, they had overextended themselves, had too much debt to equity ratio, and had too much bad debts in the subprime mortgage space, hence why they went broke. Donald Trump, his casinos in 1991, so this is the other land recession prior to 2008, his all his casinos went broke. He had massive loans out on about 3 or 4 casinos in Atlantic City in the States. And during the 91 recession we had to have, the revenues he was receiving from his casinos was not servicing his loan. So he had to fold on those investments. Harry Triguboff is the biggest Australian developer, and he's worth over 16 billion. He's built over 80,000 units. He almost went broke. He's 90 years of age. He started in 1963 when he was 30, and he was heavily leveraged in 1972, which was the land-driven downturn prior to the 91 downturn. He almost went broke in 1972, was heavily leveraged with Citibank, a US bank. Years leading up to the peak in 1970, in the late 60s, the bankers from the States were coming to Australia, and they were saying how good of a job Harry was doing with his investments and building. 1 or 2 years later in the downturn, they thought he was broke. So there's a famous interview of him where where the bankers are trying to get their money back out of Harry, and he decides to continue to build more units, and basically said to the bankers, I've got no more money left, but I'm happy to give you half-built construction projects. So if you want to try and send me broke, I'll send you broke. So that's another pinpoint where he then vowed after 1972 to never use banks ever again. And to this day, he's a self-funded property developer. So these are quite interesting points in time and used as references, which I've overlaid on top of the studies from the books, from the work that Fred Harrison and Phil J. Anson have done, to overlay and pinpoint where these land-driven downturns have happened. And they go back all the way back to 1800. So these are the last three cycles, or we're currently in the third cycle to this date, but these are the last three. So right now we're in a good position now to invest, and as we enter the land boom, it's becomes more critical to make sure that you are paying value for property, you have strong yields, you're not overextending yourself, you have good cash buffers, and you are not overextending yourself and potentially exposing yourself to the next land-driven downturn. So anyway, thought I'd explain a little bit more about the 18-year cycle. Just a disclaimer, this is by no means any investment, legal, financial, tax advice. It's general information in nature. If you are looking to buy property and get into property, you should get independent advice before buying any such property. Thanks for watching. I'll see you next time.